Hello, this is Jessica Dunn, and this is Chapter 4. We will be discussing cash flow and financial planning. Cash flow, as opposed to profits, is the primary ingredient in a financial valuation model. The reason for this is because profits are important, but if you can't pay your electric bill at the end of the month, then your company can't operate. So cash flows are very important. Cash flow is summarized in a firm's statement of cash flows from an accounting perspective, but from a financial perspective, firms often focus on both operating cash flow, which is used in managerial decision making, and free cash flow. Free cash flow is often monitored by others. It's often used as a measure of firm valuation. So you can use the free cash flow that a company has and determine the value of that company. First off, we're going to talk about depreciation. Depreciation is the portion of the cost of the fixed assets that are charged against annual revenues over time. We calculate depreciation for tax purposes using the modified accelerated cost recovery system. But there are a variety of other depreciation methods that do exist and are often used for reporting purposes. So here's a quick little example. Baker Company, they purchased a new machine. The new machine cost $38,000. It cost $2,000 to install the machine, and whenever it is retired from service, so whenever they're done using it, it will have a salvage value of $1,000. So, what is the depreciable value of this machine? When determining depreciable value, we do not include salvage value. Salvage value is not a set in stone thing that we know for sure is going to happen, so we don't include it. So the depreciable value of this machine is $38,000 plus $2,000 to give us $40,000. So using the modified accelerated cost recovery system, the depreciable value is its full cost including the cost of installation. We do not adjust the depreciable value with the salvage value. So we're only looking at the cost of the machine plus installation cost. We do not include salvage values. The depreciable life of an asset is determined by these different property classes. So there's a 3-year, 5-year, 7, and 10. And depending upon what type of equipment that you've purchased, it's going to fall into a different property class. So the 3-year recovery period, this is for research equipment and certain special tools. 5-year, computers, printers, copiers, vehicles, trucks, technological equipment, and similar assets. 7 years is furniture, fixtures, manufacturing equipment, railroad tracks. 10 years, this would be equipment that's used in petroleum or the manufacturing of tobacco products and some food products. So once we've determined our property class, so our recovery period, how long does it take us to charge off the expense of the asset, we are able to calculate depreciation by year. So for example, if we had an asset with a 3-year recovery period, so that would fall into the first category, research equipment and certain special tools, then 33% of the cost of the machine plus installation cost would be charged off the first year, 45% the second year, 15% the third year, and 7% the fourth year. One thing to notice is that you are accounting for 100% of the cost of the asset and installation. So the sum of these must be 100%. So here's an example. Baker Company, they purchased their asset for $38,000. It cost $2,000 to install it, so they have an installed cost of $40,000. The depreciable value of their asset is $40,000. This machine has a recovery period of 5 years. So using the rates from this table, we can determine what is their depreciation expense per year. So we're going to recover 20% the first year, 32% the second year, 19% the third year, 12% in years 4 and 5, and 5% in year 6. The $40,000 cost does not change per year. And then we use these percentages, they're from table 4.2. So in year 1, we are going to recover 20%. Year 2 was 32, 19, 12, 12, and 5. So we can calculate our depreciation expense. So we simply take our percentage and multiply it by the cost. So for year 1, that is 20% times $40,000. So that gives us $8,000 in depreciation expense for year 1. Year 2, 32% times $40,000. That is $12,800. Year 3 is 19% times $40,000. So $7,600. Year 4 and 5 is 12% times $40,000. So $4,800. And in year 6, we have 5% times $40,000 to give us $2,000. So the statement of cash flow summarizes the firm's cash flows over a given period of time. Cash flows fall into 3 different categories. Operating cash flows are the cash flows directly related to the sale and production of a firm's products and services. Investment cash flows, these are cash flows associated with the purchase and sale of fixed assets and equity in other firms. So if you as a company purchase or sell fixed assets, this would be an investment cash flow. Or if you make an equity investment in another firm, so you're purchasing a portion of another company, that would also be an investment cash flow. Financing cash flows, these are cash flows that result from debt and equity financing transactions. And we're going to go through some examples. So an inflow of cash would be a decrease in any asset. So a decrease in an asset on your balance sheet means that you have sold something. If you sold something, then you receive cash for it. An increase in any liability on your balance sheet means that you have borrowed money. If you borrow money, that's going to increase your cash balance. Net profits after taxes results in an increase in cash. Depreciation results in an increase in cash. And the sale of stock. So here, if you've sold stock, you have sold equity, which results in positive cash flows. Uses of cash, an increase in any asset. So if you increase your assets on the balance sheet, that means that you have purchased an asset, and you have typically done so with cash. A decrease in any liability. So if you decrease your liabilities, that means that you have paid off debt, and you have used cash to do so. A net loss would result in loss of cash. If you pay dividends, that would be a cash use. Or if you repurchase or retire any stock. All cash outflows are treated as negatives. The statement of cash flows ties the balance sheet at the beginning of the period with the balance sheet at the end of the period after considering the performance of the firm during the period through the income statement. So it's tying together 2 balance sheets and 1 income statement. The change in cash and marketable securities should be equal to the difference between the cash and marketable securities on the balance sheet at the beginning of the year and the end of the year. So operating cash flow. This is the cash flow that a firm generates from day-to-day operations. from the production and sale of its goods and services. We can calculate operating cash flow. Operating cash flow is calculated using these equations. First off, we have NOPAT. This is net operating profit after tax. Net operating profit after tax. It's equal to your earnings before interest and tax. Tax times 1 minus your tax rate. Operating cash flow then is equal to your net operating profit after tax plus depreciation. So you can combine the first and second equations together to make this third equation, where operating cash flow is equal to earnings before interest and tax times 1 minus the tax rate plus depreciation. So if we use this for Baker Company, we will see that our operating cash flow is equal to our earnings before interest and tax of $370 times 1 minus our tax rate of 40% plus our depreciation expense of $100. So that gives us $322. These numbers, if you can't find them, are available on Canvas. They are under the Chapter 4 header, and they're called Baker Company. And so earnings before interest and tax was $370 times 1 minus our tax rate of 40% plus our depreciation expense, which is $100. You can find these on different places. They're all available on the income statement. Your earnings before interest and tax is about halfway down. Depreciation expenses on the upper half, and your tax rate is on the bottom half of the income statement. So from this, we can see that Baker's operations are generating positive operating cash flows. So they do have profitable operations. But free cash flow is not just the cash flow that's generated through operations. It also accounts for our financing and our investment activities. So free cash flow is the amount of cash flow available to investors, both creditors and equity owners. It's the amount of cash available to them once the firm has met all of their operating needs and paid for investments in net fixed assets and net current assets. So our net fixed asset investment. I turned my pen back on. Net fixed asset investment. And NCAI is our net current asset investment. So our net fixed asset investment, this is the change in our net fixed assets plus depreciation. Our net current asset investment, this is the change in our current assets minus the change in accounts payable and the change in accruals. So using Baker Company, we see that our next net fixed asset investment is equal to the change in our net fixed assets plus depreciation. So using Baker Company, we see that from 2012 to 2011, our net fixed assets have increased $200. So we have $1,200 in 2012 minus $1,000 in year 2011. This is on the bottom half of the first page. And then we add to that our depreciation. Our depreciation is found on the income statement. Our depreciation expense is $100. So that gives us $300. Our net current asset investment is equal to the change in our current assets minus the change in our accounts payable. And I'm just going to distribute the negative sign and say the change in accruals as well. So the change in our current assets is found on the balance sheet. And we see that it's gone from 1900 in 2011 to 2000 in 2012. From that, we deduct our change in accounts payable. Our accounts payable is also found on the balance sheet. It's on the top half of the second page. 700 in 2012 and 500 in 2011. Minus our change in accruals. Accruals is 100 in 2012 and 200 in 2011. And so that is a $0 net current asset investment. So now we're able to calculate free cash flow. Remember that free cash flow is equal to your operating cash flow minus your net fixed asset investment minus your net current asset investment. So our operating cash flow was $322. From that, we deduct our net fixed asset investment of $300 and our net current asset investment of $0. So that gives us $22. So we do have positive free cash flow. So that means that we have adequate cash flow to cover all of our operating costs and to cover all of our investments, and we had free cash flow available to pay investors. Remember, this is important because investors use free cash flow to determine the value of the company. There are different uses of free cash flow. First, you would pay interest on your debt. Second, pay principal on your debt. Third, pay dividends. Fourth, repurchase stock. And fifth, buy investments. Free cash flow is often considered a more reliable measure of income than reported earnings. And here's an example of that. At Cisco Systems, May 13, 2010, they reported earnings per share of 42 cents. Wall Street analysts expected earnings per share to only be 39 cents, so they beat their expectations by 3 pennies. These 3 pennies were attributable to the fact that the quarter was 14 weeks rather than 13 weeks, unusual tax gains, and some other vague other income classification. So each of these 3 pennies was attributable to different reasons, and none of these reasons were specifically under Cisco Systems control. So free cash flow may be a more reliable measure than reported earnings. The financial planning process begins with long-term financial plans. These long-term financial plans guide the formulation of short-term plans. There are 2 key aspects of financial planning. The first is cash planning, and the second is profit planning. So cash planning involves the preparation of a firm's cash budget. Profit planning involves preparing pro forma income and balance sheets. Long-term financial plans lay out a company's planned financial actions over a period from 2 to 10 years. The period is so vague because if a firm has large degrees of uncertainty, meaning that they don't know what's going to happen in the future, or if they have short production cycles, then they often use shorter planning horizons because there's so much uncertainty in their business. If a company is in a more stable environment, they're going to use a longer a longer planning horizon. Long-term financial plans consider many activities, such as a fixed asset investment. So do you need to upgrade your manufacturing equipment? R&D activities. What are you planning for the future? Marketing and product development, capital structure, sources of financing. And these plans are supported by a series of annual budgets and profit plans. Short-term financial plans look at short-term actions and the impact of those actions. The key input of a short-term financial plan would be a sales forecast. So a sales forecast is simply an expectation of the amount of sales that you're going to have that year or that period, whatever your short-term horizon is. The outputs from this data would be your operating budget, your cash budget, and your pro forma financial statements. So a short-term financial plan begins with a sales forecast. From this sales forecast, production plans are developed. These production plans are going to consider lead times and raw material requirements. From the production plans, labor, factory overhead, and operating expense estimates are developed. From this information, the pro forma income statement and cash budget are prepared. And these two together ultimately lead to the pro forma balance sheet. So the first step is to define your goals. For example, a college senior's intermediate term goal might be to earn a master's degree. Their long-term goal might be to buy a home. And so we first determine what we want to happen, throughout our plan. We want to have a profitable company. So now what do we have to do to have a profitable company? Perhaps our ultimate goal is to be a nationwide company with franchises all over the place. So perhaps our intermediate goal should be to have a franchise in each major city across the United States. Our short-term goal should be to develop our current company well enough that someone would be willing to purchase a franchise. The cash budget or cash forecast is a statement of the firm's planned inflows and outflows of cash. It is used to estimate short-term cash requirements. The cash budget is designed to cover a one-year period, usually divided into smaller time intervals. If a company has more uncertainty, there will be a greater number of intervals. The primary input into this is a sales forecast. So a sales forecast is a prediction of the sales activity during a given period. It can use both internal and external data. Internal data would be a sales forecast based on the firm's own sales channels. So an example would be you would contact your salesman and ask them how much you anticipate they can sell this year and use that information. An external forecast would use predictions of the economy. So we know that in a good year, we have sales of $100,000. But this year is supposed to be really bad, and so we're going to drop that down and anticipate sales of $80,000. Or it could be a combination of the two. You contact your sales team, ask them how much they anticipate selling, and then you move that number up or down based on economic criteria. And so here is the general format of a cash budget. We start with our cash receipts. We subtract our cash disbursements. That gives us our net cash flow. Add back our beginning cash, and that gives us our ending cash flow. Subtract our cash balance, our minimum required cash balance, and that tells us if we need to borrow money or if we'll have money left over to invest. So this looks nice and simple, but this is really going to be three tables combined, so it takes a little bit longer than it actually looks like it does. And so for Colson Industries, they're a defense contractor. They're developing a cash budget. They had sales in August and September of 100,000 and 200,000. And they have forecasted sales in October, November, and December of 400,000, 300,000, and 200,000. Historically, 20% of the firm's sales have been for cash, 50% have been collected 1 month after sale, and the remaining 30% 2 months after sale. In December, Colson Industries will also receive a $30,000 dividend from stock in a subsidiary. So we need to calculate our cash receipts, the very first line. So the very first line are cash receipts. This is a table all in itself. So they're wanting a cash budget developed for October, November, and December, but because some of the information is lagged, we will have to include the numbers from August and September. And so at the top here, I'm just going to write the sales forecast. August is no longer a forecast because we know they had sales of 100. September was 200. In October, they're expecting to sell 400, 300 in November, and 200 in December. And so that is just there as a reference tool. So the problem says that historically 20% of the firm's sales have been for cash. Okay, so in August, that means that they collected 20% of their $100 in sales that month. In September, 20% of 200 is 40, 20% of 400 is 80, 20% of 300 is 60, and 20% of 200 is 40. So I simply took 20% and multiplied it by the sales forecast. And now it says that 50% of our sales were made on credit, so accounts receivable, and 20% of them, 50% of them are received 1 month after sale. So we can't calculate the number for August because we don't have July's numbers. So we'll go straight to September. So in September, we are going to be collecting 50% of the sales made in August. So 50% times 100 is 50. In October, we will be collecting 50% of September's $200 in sales, so that's 100. November, we will collect 50% of October sales, so 200. And in December, we'll collect 50% of November sales, 150. So what I did here was 50% times sales in the 1 month prior. So there is a -1 there that is in the, it's a small -1. It's not a -1. I'm just using it to denote time. And the remaining 30% of sales are collected 2 months after sale. So what I'm going to do here is I'm going to take 30% times the sales from 2 time periods prior. So I cannot calculate sales for September, or accounts receivable for the second month for September, because I don't know July's sales. So we're going to go straight to October. So in October, we will be collecting 30% of August sales. In November, we will collect 30% of September sales. And in December, we will collect 30% of October sales. So 30% times 400 is 120. And the problem also says that in December, Colson will receive $30,000 dividend from stock in a subsidiary. Okay, so now we just add these up. So August, we don't have all the numbers, so it's quite small. September, October, 80 plus 100 plus 30, 210. November, 60, 260 is 320. In December, we have 40, 150, 120, and our dividend of 30, so 340. And so all of this work was put in just to get the first line of the cash budget, the cash receipts. The second step will be to calculate cash disbursements. So cash disbursements. Here is the pertinent information. Purchases are 70% of sales. 10% are paid for immediately with cash. 70% are paid the month following purchase. And the remaining 20% is paid 2 months following purchase. So just like we had accounts receivable, this is accounts payable. Well, we will also have to pay for our rent, wages, salaries, taxes, capital assets, interest, dividends, and loan payments. And so here is our cash disbursements. We had estimated that our purchases would be 70% of sales. So 70% of our sales receipts. Remember our from our sales forecast was 100, 200, 400, 300, and 200. And so that's where this is coming from. We multiplied 70% times our sales forecast for each of these to give us our purchases. Now, typically, of our purchases, 10% are in the form of cash. So we take 10% and multiply it by our purchases. So 10% times 70 gives us $7. 10% times 140 gives us 14, and so on. 70% of our purchases are paid for 1 month after receipt. So we take 70% times our purchases for the month prior. So for September, we take 70% of August's purchases of $70. So 70% of 70 is 49. For October, 70% of 140 is 98, and so on. 20% of our sales, or of our payments towards accounts payable, are from purchases made 2 months prior. So again, those are small numbers there. It's denoting time. So we had to go straight to October because we don't have July's numbers. So for October, we take 20% times our purchases in August, and that gives us our payment in October of 14. November, this is 20% of the purchases made in September to give us 28. And so you can do that for each month. And then we're going to have rent, we're going to have wages and salaries, and all of the rest of this would have been given to you in a much prettier format. This is just an example. You sum these up and that gives you total cash disbursements. So if we go back and look at what we're looking for, that is line number 2 in our cash budget. Now we're ready to put all this together, however. We do have a minimum required cash balance of $25,000. And we do know that at the end of September, they had a cash balance of $50,000. So at the end of September, their cash balance was $50,000. Notes payable was 0. Marketable securities was 0. And so we will develop our cash budget for October, November, and December. So we have our cash receipts, what we calculated in this first table, 210, 320, and 340. We subtract our disbursements, our cash disbursements, which is what we just got done talking about, 213, 418, and 305. 213, 418, and 305. So that gives us our net cash flow. So in October, we brought in 210, but we spent 213, so that gives us a -3. In November, -9, oh, excuse me. Okay, so we have our net cash flow of a -$3,000. Our next step is to add our beginning cash balance. So here the problem says that at the end of September we had a cash balance of $50,000. So that means at the beginning of October we would have $50,000 in our account. And that gives us our ending cash. So if we spent $3,000 more than we brought in, but we had $50,000 in our account to start with, that means that we have an ending cash balance of $47,000. And so for November, we spent $418,000 and brought in $320,000. So we spent $98,000 more than we had. Our beginning cash balance in November is our ending cash balance from October. So $47,000. So we spent $98,000 more than we had, and we only had $47,000 in the bank. So now our ending cash balance is a -$51,000. In December, we made $35,000. We brought in $340,000, spent $305,000, so we made $300,000, and we made $35,000. Our beginning cash balance, however, is negative still. So we still haven't made that up, so we're still a -$16,000. Our company also wants to maintain a minimum cash balance of $25,000. So we need to deduct this. So in October, $47,000 minus $25,000 gives us $22,000. So we have a positive number. That means that we have excess cash. We have $22,000 more than our minimum requirement. So therefore, we can invest that in marketable securities. In November, we had a -$51,000 cash balance, and we needed an additional $25,000 on top of that. So we are a -$76,000. That means that we need financing of up to $76,000. In December, we had profitable operations, and we reduced our negative number from -51 to -16. But we still need $25,000 in our cash drawer, so we still have a -$41,000. So what this means is that we have a positive number in October. Positive means that you have cash left over. We have negative numbers in November and December. That means that we need to have some sort of financing set up so that we can make this, make it through the winter. And so here we can see this again. If we're wanting to maintain a cash balance of $25,000, that in October we had an excess $22,000 to invest in marketable securities. November, we use up that entire $22,000 and borrow an additional $76,000. From November to December, we have improved. now we have repaid a portion of our notes payable. So we've repaid $35,000 of our notes payable, but we still owe $41,000 in December. Individuals, we prepare budgets just like this example. We have our pay, our income minus our expenses, and we also determine whether or not we will have a surplus or a deficit. So we may know that in December our property tax comes due. So we need to have a surplus every month up until December, because in December we're going to have a massive bill that's coming due. There is uncertainty in your cash budget because it is based on forecasts. And so it's a lot of companies will opt to prepare several cash budgets based on different forecasts. So you're going to use forecasted scenarios. So what would happen in the best case and the worst case and the most likely scenarios. From looking at these different ranges that you're going to calculate, you can determine the maximum amount of financing necessary to cover the most adverse situation. So you could look at this and say, well, in the very, very worst scenario, in the very worst month of the year, we're going to be short $2 million. So I need to have set up some sort of financing up to $2 million. So perhaps a line of credit. And so here is an example of this sensitivity analysis for Colson Industries. So here we have the same months, October, November, December. But now we have what would happen in the worst scenario and the best scenario for each month. And so in the most pessimistic scenario for October, we're going to be $15,000 short. In the best scenario, we're going to be $62,000 over. And so we're going to continue these scenarios, and we can see that in the very, very worst scenario, the most financing required is $190,000. And in the most optimistic scenario, we have an excess cash of $107,000. So I need to have plans in my head as the financial manager of where am I going to get this $190,000, and what would I do if I made $107,000. So would I use this money to invest in marketable securities? If things go my way, will I introduce a new product to the market? Or if things don't go my way, so if I need up to $190,000, do I have that cash available to me? I need to be talking to banks now so that way I can be prepared for December. Pro forma financial statements, these are projected or forecasted income statements and balance sheets. To develop a pro forma statement, you're going to need your financial statements from the previous year, the sales forecast for the coming year, and you're going to need to make some different assumptions. So here we are. We're going to be looking at Vectra Manufacturing. We have their sales forecast for 2013. So this sales forecast that we're looking at here is based on a increase in price from $20 to $25 for Model X, and an increase in price from $40 to $50 for Model Y. And so we're looking at the number of sales and the total dollar sales. We need to increase the purchase price of these models to cover increases in our costs, including labor, materials, and overhead. And so a simple method for developing a pro forma income statement is using the percent of sales method. This method starts with a sales forecast and then expresses each of the costs as a percentage of projected sales. So it looks at your cost of goods sold, your operating expenses, your interest expense as a percentage of your sales. And so we can do this. And so you can find this information on Canvas. It is under the Chapter 4, and it is called Vectra. So if we're going to prepare our pro forma income statement, we're going to look at historical numbers and then translate them to the future. Okay, so this means that in 2012, so I'm looking at the income statement for Vectra in 2012, I see that our cost of goods sold is $80,000. And we're going to divide that by sales. Our total sales were $100,000. So cost of goods sold as a percentage of sales is 80%. We'll do the same thing for operating expenses. Look at them as a percentage of sales. Operating expenses are $10,000. Divide that by 100,000 in sales, and that gives you 10%. Our interest expense is 1,000 over our sales of 100,000, and so that's 1%. And so now we can use these numbers to translate our sales forecast. And so this year, this is our 2013 numbers, we have sales of $135,000. I'm getting this from the sales forecast. From that, we deduct our cost of goods sold. Remember, we said last year cost of goods sold was 80% of sales, and so we're going to assume that that number holds this year as well. So 80% of 135,000 is 108,000. So simply took 135 times 80%. And that gives you your gross profits. From that, we deduct our operating expense, which we said last year was 10%, and we're going to assume that holds. So that's 13,500. That's 135,000 times 10%. That gives us our operating profit of 27,000 minus 13,500 gives us 13,500. Minus our interest expense of 1%. So that's 1,350. That gives us our earnings before interest and before tax of 12,150. We subtract our taxes, which last year was 15%, so we're going to assume that's the same. And so that's 1,823. That gives us our profit after tax of 10,327. If we assume that dividends are the same, 4,000, then that would leave us $6,327 left over to go towards retained earnings. So I'm going to finish that up here. So, excuse me, I ran out of room. Minus 4,000 for common stock dividends. And that gives us the amount towards retained earnings of 6,327. So some of the expenses do increase with the level of sales and some do not. The problem with this is that we're assuming that all costs are variable, which in reality, some are going to be fixed and some are going to be variable. So you would get a more realistic pro forma income statement if you segmented expenses into both their fixed and variable components. Using these variable components and historical ratios often causes us to understate profits when sales are increasing and overstate profits when sales are decreasing. A judgmental approach is used to develop the pro forma balance sheet. Here we're basically just using our best guess, and different assumptions will have to be made. So on Canvas, on your paper there, it has your 2013 assumptions. It says that there must be a minimum cash balance of $6,000. Purchases are 30% of sales. Marketable securities, inventory, notes payable, other current liabilities, long-term debt, and common stock are unchanged. The average collection period remains the same. Average payment period is 73 days. And tax payable will be $455. Retained earnings increases by the $6,327 we calculated from a pro forma income statement, and net fixed assets increase $13,000. And so with these assumptions, we know that we can do the asset side of a balance sheet first. We know that within the assets first is cash, and our assumption says that the cash balance is $6,000. Our marketable securities have not changed, and so they will be $4,000, just as they were the previous year. And our accounts receivable. Our average collection period will remain the same, and so number 4 in the assumptions, this says that our accounts receivable will total $17,550. If we total those up, we also have inventory, excuse me. Inventory does not change according to assumption number 2, so it is $16,000. And that gives us our current assets. We sum these up and we get $43,550. Our fixed assets. Fixed assets are $64,000. Because assumption number 8 says that fixed assets will increase $13,000. So $64,000. So that gives us our total assets of $107,550. So now we can do our liabilities and equity. We have our accounts payable. Footnote number 5, or assumption number 5, $8,100. Taxes payable, assumption number 6 is $455. Notes payable does not change. Assumption number 3, so that's $8,300. Our other current liabilities also do not change, which is assumption number 3. So they remain constant at $3,400. Oh, excuse me. So that gives us current liabilities of $20,255. Our long-term debt also remains unchanged, assumption number 3. So that gives us our total liabilities of $38,255. Common stock also does not change at $30,000. Our retained earnings does increase by the amount in our pro forma income statement, which is assumption number 7. And so that gives us a total liability and equity of $97,582, which is different from our total assets by $9,968. And so we would have to have external financing. So our common stock was $30,000, and retained earnings $29,327 to give us our total of $97,582, which is not the same as our $107,550. We know that it has to be, and so we do have to have external financing in the amount of the difference. And so that would give us our total liability and equity of $107,550. So we do have to use a plug figure. The major weaknesses of the pro forma statements is 2 assumptions. First, we're assuming that past financial performance can be replicated in the future, and that certain variables can be forced to take on desired values, which is probably not very realistic. However, they are used, and analysts do need to know how to understand them and how to use them to make financial decisions. Um, you can use your pro forma statements to calculate financial ratios and to give you an estimate of what may happen in the future.